Hi students, this is KUMAR, Senior Faculty for Financial Management, Costing and Strategic Financial Management subjects. In this video, I'm going to highlight the importance of NPV approach, which is the best discounted cash flow technique. So let us start our discussion. What is NPV? NPV means net present value. So what is the purpose of computing the NPV? Say business requires short-term assets as well as long-term assets. Long-term assets like land and building, plant and machinery, furniture, etc. require substantial capital expenditure in today's or in near future in anticipation of or to get the profit from the near future. Say for example, a company wants to construct a factory building. It requires land, it requires construction, it requires machinery, it requires furniture. All these assets are what? Long-term assets. Suppose the company is estimating that to construct the factory building, 25 crores are required. If 25 crores are required, the project getting completed, but when do you get the return? In future. Suppose the life of the project is 10 years. In the next 10 years, you are going to produce the product, you are going to sell the product, you are going to get some profit. So first year, second year, third year, fourth year, fifth year, sixth year, like this. In the next 10 years, you are going to get profit. By the end of the 10th year, we want to terminate the process where all the assets in the projects will be disposed of. Land will be sold. We don't need furniture. We don't need a factory building. All the assets are disposed. The money which is fetching from those assets, that will be the terminal cash flow that will be received at the end of the 10th year. Now, here, why you are constructing the factory building? Basic question. We are constructing the factory building to get profit because we are operating the company on behalf of the shareholders. We are the agents of the shareholders. So my primary role as a board of director is to maximize the wealth of the shareholders because we are doing business on behalf of the shareholders. We are putting money which is not belongs to the board of directors, that belongs to who? Shareholders. Therefore, your primary objective is to maximize the wealth of the shareholders. Now, you have to understand before making investment, 25 crores are needed. Today we need 25 crores, we need to invest 25 crores. Second thing, how many years you are going to recover this investment? 10 years. So now 25 crores are needed, that is expected to be recovered in 10 years span. Can I make a profit? Is there is any risk in the investment? These two fundamental questions will arise at the time of investment. To answer or to resolve this issue, we use a concept called NPV. So NPV is a tool which is available to the decision maker to understand how much profit he is going to make or how much loss he is going to suffer in future. So this is what NPV indicates. Expected profit or expected loss from the project. How it is estimated. It takes 10 years profit. First year, second year, third year, fourth year, and so on. All these profits are converted into today's value. Then from this, your investment will be deducted. If any surplus is there, if it is positive, it is going to be the profit. If there is any surplus is there, if it is negative, means you are suffering a loss from the project. All those loss-making projects are rejected. Only profit-making projects are accepted. So this is how the NPV is estimated. A project with a positive NPV maximizes the wealth of the shareholders. A project with negative NPV destroys the wealth of the shareholders. Suppose you are putting money where you are getting huge profits. Then what happened? Every year, the extra profit after meeting the capital cost of the company goes to the reserves. Then what happened? Book value of equity increases. Then what happened? Book value per share increases. Then what happened? It helps to increase the market price of the share. So increasing the market price of the share, that we refer as wealth maximization. So NPV indicates the expected profit. If expected profit is there from the long-term investment, that helps to maximize the wealth of the shareholders. Now you are going to learn how the NPV is estimated. So take a small example. Say a company called X Limited wants to purchase a machine which is required for the production line. So this machine requires an investment of say 40,000 today. Life of the machine 5 years. Life of the machine 5 years. The cash flows are estimated first year, second year, third year, fourth year, fifth year. These cash flows are called as operating cash flows because we are getting profit by operating the machine. So this 5,000 rupees, 7,000 is operating cash flow, 5,000. So we don't need this machine after 5 years, we want to sell it. The sale value of machine after 5 years is called as terminal cash flow. So operating cash flows are estimated, terminal cash flows are estimated. Investment is estimated. Third one, life of the project is estimated 5 years. And here, what is 12%? If 40,000 is not invested on this machine, I have an alternative where I can make investment in a share market where I'm going to get 12% rate of it. So here, to purchase the machine, I have to withdraw my investment from the stock market. That means I'm losing 12% return there. So this 12% becomes opportunity cost. So take this one. Look at this. 12,000, 12,000, 12,000. In the next 5 years, what I did, I am discounting at 12%, means I am deducting 12% interest from the profit every year. So after getting 12% interest, I am going to have 10,740 from the first year cash flow, 9,566 from the second year cash flow, 8,541 from the third year cash flow, and so on. So that means today I have 43,257.31 rupees, which I can use to recover my investment. Now tell me, out of 43,257, if I recover 40,000, still I left with what? 3,257.37 point, how much? 31. This is called NPV, expected profit from the process. See, what it indicates, 43,257 is the cash available as on today after recovering the 12% interest from the cash flows. So I am recovering my opportunity cost. Still I left with 43,000. But how much is the investment? 40,000 means still after getting your investment, you left with a profit of what? Cash of 43,257. This is called NPV. Here NPV positive means you are getting profit from the process. Suppose the sum of cash inflows are say 38,000. You left with the cash balance of what? 38,000 after recovering the interest of what? 12%. But what is your investment? How much money you are investing in this project? 40 means you left with a loss of what? 2,000. That is called negative NPV. A project with negative NPV is a loss-making project. We don't require, we reject it. A project with positive NPV is a profit-making project where I want to accept it. So the fate of the project means profit depends on what? The money you are investing today, the life of the project, operating cash flows, terminal cash flows, discounting factor. All these factors decides the accuracy of NPV. If any estimate goes wrong, the NPV estimator is going to wrong. Hence, the accuracy of NPV depends on the accuracy of estimation, which is quite difficult. See, what I anticipated that in the next 5 years, there will be, say, 4 players in the industry. Accordingly, I have estimated these cash flows. But at the time of execution of the project, there are 6 players. Then what happened? Due to competition, you have to curtail your selling price. Thereby, you're not going to get 12,000 profit every year. Then NPV goes down. At the time of evaluation, we estimate that there will be, say, 5 players in the industry. But in fact, at the time of execution of the project, only 4 players are there. That helps to, there will be limited competition. You can increase your selling price. You can enjoy the monopoly market conditions so that you are going to get extra profit. That helps to increase your NPV. So NPV is quite sensitive to all these factors. If any factor goes wrong, if any factor changes its sign, then there will be corresponding effect on the NPV. That's all. This is what NPV is.